Welcome to Plain Talk with Trillium Wealth. My name's Steve Laska. I'm the managing partner here at Trillium Wealth, and I'm here with my partner and our chief investment officer, Matt Gomoll. This one I think might be a little bit shorter on what we're doing because we're going to be like very direct topical on this one, Matt. Let's talk a little bit about IPOs. Like everybody just had the SpaceX IPO, and there's a lot of euphoria. I talked about how it just went so far up, so far down, so far back in the middle. But there's a lot of excitement on a lot of them coming up. Like this is, SpaceX was one, but I think there are some really big names that are about to launch. And you have some insights on there's different ways to launch an IPO, right? Like, is it all available or is there some tiny part available? And what does that mean? And if we take did Elon Musk with his kind of background and power set a new paradigm for others to follow, or was he an outlier? I'd love to hear your opinions on what it'll look like with things like Anthropic and others.
Yeah, Elon's always an outlier. He is one of one. He's a unique figure in the technology, manufacturing, investing space. He's just very unique. However, I think some of the things he did might be replicated by the next major. I mean, the idea of $1 trillion IPO is crazy. It is not something that markets have seen before. So it's very unique and kind of it's a sign of the times of these types of companies have been able to stay private this long and now IPO at over $1 trillion. So Elon's unique. However, I do think Anthropic and OpenAI are going to follow suit and do some similar things to what he did. I think they're going to have some pricing control on setting. I think they can go out with a low float. I think they can get inclusion in the indexes pretty quickly, just the way he did. So those are all major differences from what we would have seen on a normal IPO that comes in at a couple $2 billion.
Although we talked about it before, Matt, like give our clients a little bit of insight on, like, I think they understand indexes, like being in the S&P or NASDAQ or the Russell, but float. Talk to a little bit about what it means and why the lower float allows probably more stability in the IPO price, where it's going to go up and come back down. But ones we've seen in the past, it hasn't been uncommon for much lower share price than Musk, but it launches at 20 and by the end of the month it's at 12. Why is it? What does float mean to our investors, and why does that kind of cause a little bit of price stability and leave power in the hands of the current major shareholders?
Yeah, so float is the idea of how much of a stock has 100% shares, but only some amount of those shares are being publicly issued for trading. Right. In the case of SpaceX, Elon owns the majority of the company. He wasn't trading anything, and his stuff was locked up. A lot of the other insiders, whether they're employees who did very well, having been working there for years, they had stock that's locked up. Also private investors, right? Venture capital funds and maybe some private equity funds who got in towards the end. All those folks have lockups. That SpaceX was a little complicated, but there's a timeline to be able to free up those shares and sell. So there was a chunk of shares. It was only, I think it was like 4.5% of the total shares that were available for trading that first week. So that was the float. Float was like $70 billion or so at the issue price of 135. And so while the headline is this is a $1.7 trillion company or whatever at IPO, it's really a $70 billion chunk of stock that's available out there, right? That's all it is. And so that, when you don't issue that much stock for sale and there's plenty of demand, well, there's more buyers than there is stock available. Price went up. Now, over the period of time, last couple weeks, it's traded a little more normally, right? Like pop happened over the first few days. It came back down. It still hasn't breached its issue price at 135. but we're entering a period where more and more stock's going to be available because more floats available. The lockups from those private investors, the insiders, are coming available to the market right as some of the indexes are set to include it. Right. So as the NASDAQ set to include it, and the Russell and the CRISP index are set to include it in their index, well, that's going to drive some demand as new, float becomes available. So there's a little bit of that back and forth of supply and demand, and creating a little bit of stability that we might not have seen otherwise. And I do think that's a technique that Anthropic or OpenAI might try to replicate.
Do you foresee, like, when we talk about the indexes, if you look at certain cap weighted indexes and all that they want to be included in, if there's not enough for them to purchase within their index?
Yeah. So like, some of the indexes are going to look at it and say, oh, there's $70 billion of stock available. That makes it this weight in our index. And so we're going to weight it appropriately. The NASDAQ came out and I think they did like a 3-time multiplier on float. So they were considering it a 200 and something billion dollar stock. And now, wherever it trades upon inclusion day. So they're sizing it a little bigger than the actual float, but not nearly. It's not weighted in the index as a $2 trillion dollar company or whatever it is today. So yeah, there's a little bit of nuance of how they're doing it, and frankly, they want to find shares, and I think some of the buyers of SpaceX IPO were what we would call like warehousing stock, like might be hedge funds, might be institutions who say, hey, I'm just going to buy it at this price and hold it for a few weeks because I know NASDAQ's going to come in and they're just going to buy it from me. So that's kind of going on, right? So some of those institutional players or hedge funds might offload their stock because it wasn't a long-term investment for them. It was really just a trade, get from here to, I know there's going to be these buyers coming.
So let's talk a little bit, like, while they're wonderful opportunities, don't get me wrong. Like, Anthropic's going to be a strong stock. Like, it's not, I don't see it as very speculative at this point. That's the upside to $1 trillion IPOs, right? It's like, the company, like, Apple at one time was a fledgling company. Now it's a multi-trillion-dollar company. Microsoft, all these companies. In this case, these companies have been around for a good amount of time too. So I see different ways that people can get hurt, or I see different ways that people can benefit that I don't think everybody's thinking about. One, if you get into the fury of the IPO, you can get hurt. We can just look at SpaceX. I mean, there were people buying it at 230 or whatever that number was, right? There's a reason why it hit that price. There were people buying it at that.
Mm-hmm.
And so some people took it on the chin inside of a week. But there's another place, like, look, a lot of times when clients don't understand private equity, this is a way to benefit from IPOs. Like, we look at, there's some big names out there, but we use companies like Stepstone, and you've looked at other private equity investments. Like, some of these people in those investments are benefiting from IPOs more often than they think. Like, a private equity firm is going in there and being an early investor, or a venture capital fund's being in there and being an early investor. We know that Stepstone has had some where, they're buying it on the secondary market before it, goes public, and the upside to those things are really, really great. Talk about, in your job as a chief investment officer, the different ways that you see people can benefit from an IPO like that versus just getting into the fury of it.
Yeah. So, the majority of these returns are accruing to those private investors prior to IPO, right? If we think about a company like Amazon, it has something like 250,000% return since its listing.
Right.
That's insane, right? Like that, but picture all of that accrued in the public market. So as a regular investor, you could have, gotten that right, participated. You've certainly participated along the way as it's been in an index and been a large part of the S&P or the NASDAQ. These companies listing at $1 trillion, a lot of those returns already occurred. And they accrued to the private investors who are venture capital funds, private equity funds. Other, interestingly, mutual funds can actually hold some, like up to 15% of their fund in private companies. And we know some mutual funds, we've used them that have done that before. So chasing some of these and saying, oh, I'm going to get, Amazon like returns over the next 10 years. That's hard to see at these, number one, valuations and just market caps that they're entering the company. Doesn't mean you can't have good returns in them. Just there's a market difference between companies that used to go public much, much earlier in their life cycle to today, companies staying private much, much longer, which gets into, like a way to access that is through either venture capital funds, private equity funds, some certain mutual funds that we know are participating in the private markets. And so trying to say, hey, these are long-term investments, and I want to participate in that return and that value creation that's occurring in private markets versus this is my first chance in the IPO. Let me jump on the train, and it can go up for sure. Just not that like 10-bagger return that you could have had in the past, right? I don't see Anthropic 10xing in the public markets anytime soon.
And that's the best point. I think where people get excited about something is they look at something like, you give a great example on Amazon. But I will tell you, most of the people that benefited from the 250,000% return, they worked there, right? They weren't even early investors. They were early workers there. Jeff Bezos made that money. And there were like probably a handful of like private, not a private equity fund, like a guy, right, who's going, I'm going to back you. And that's what I always want to caution our clients on. These IPOs are great. And if you've heard of the company, like if it's omnipresent throughout the world right now, your upside is definitely tempered. We have lots of things. Like I said, we have investments that you're putting our wealthier clients in today that are going to benefit from IPOs on defense contractors and stuff, that they're a 25-person company right now. And there's like some real like heft of what can happen when those things go right. So while I think they're great investments, that's what I want our investors to know. Like, if Anthropic goes out at $1 trillion valuation, it's a pretty good haul for you to double your money in that stock. Like, typically the stock market will double in 6 years or so, right? So that's what I want our clients to know. While these are very exciting opportunities, don't think that if you got in SpaceX that your money's, even if you got in at the IPO, that your money's going to double in the next year. It would be hard. Like, because that is I think what folks don't realize as well is these IPOs have been heavily, heavily followed by analysts. There's no surprise on SpaceX or Anthropic. Like, there's a bunch of like really smart investment people that are looking at the numbers on those things every day. And they already have that $1 trillion valuation for a very, very good reason. I don't know how many times historically a company's gone from $1 trillion to $2 trillion. Well, there haven't been that many $1 trillion companies. So let me go back in time. There weren't a lot of times when companies, if you go back 25 years ago, when like, I might be wrong on the exact dates here, but probably 25 years ago, GE was the most valuable company in the world, or Exxon was the most valuable company in the world. And they were bumping up, not quite $1 trillion, maybe in the high hundreds of millions. So if we look historically, it would be a fun exercise for you and I to do on the investment committee to go, how many times did a company go that was already established go from 400 billion in valuation back in the day to 800 in a couple of years? Probably not. Then again, things have changed. What is your outlook on what it means for a client versus any other investment, by the way? Like, once you get past the euphoria of the IPO of SpaceX, when we go to the fall, once we get past the euphoria of Anthropic, of OpenAI, how do you, in your job, see it as the efficacy of the investment itself?
Yeah, so this gets down to a lot of the US market is wrapped up in the AI trade right now. There's a lot of companies that are tied to it. Anthropic and OpenAI are uniquely that, like, they are the frontier model. Their business model is delivering that AI model and those agents and stuff like that. Whereas a lot of the other players might be cloud providers, data center providers, software providers. Like, Amazon, Google, you know, Microsoft, Apple's taking a different take on it. Like they're all participating, but it's slightly different. These are pure plays. Even SpaceX has a AI component with their XAI, but they have a lot of other stuff going on with data centers and rockets and satellites, right? So they're a kind of a diversified company, especially if they got Cursor they bought and they might roll up Tesla, right? That might happen. So that's a very diversified play with a bunch of different business lines, whereas OpenAI and Anthropic are just pure, we need to generate revenue from users using our product. And that gets to, so it's the purest form of an AI investment. And it gets to like, is this stuff going to have economic impact? And are companies going to see value and keep paying for it? Right now, they're like Anthropic's revenue is insane growth. Like they are growing insanely like no company before. But at the point where enterprises say, ooh, I'm spending too much on this, I'm not getting enough value, or I don't like your closed model, I want an open model that I control in-house with my own data, right? We picture we went from a rack of servers to house your data, probably 20 years ago, and then we migrated to the cloud, and now we're migrating to this, we're going to use your model with our data. It might come back to companies wanting to control their own data and just use an open source model on premises. So that's kind of where I see it. I'm not sure. It will be good for them to be public. That's good, but there's certainly risk involved. And if their business case proves out and they're valuable and they're adding value to their customers, those companies are going to pay a lot of money for that service. If not, if they're worried about privacy and data retention and all these things, then Anthropic and OpenAI have kind of a business risk to them.
So historically, when you look at companies, and those are great, I love the juxtaposition actually, because I can tie it back to the past. Like a lot of companies, when they're doing an IPO or they're early in the kind of euphoria, they're not profitable yet. I mean, they're literally their valuation is based on what they think it's going to be, and it might be based on top line revenue. I mean, Amazon was a great example of that. Bezos spoke at the Washington Economic Forum 7 or 8 years ago and said, we were always profitable at the end point, but we weren't profitable as a company. And that's what he was judging it on. Like on that end point, what I bought this for and what I sold it for, I'm profitable on. Now the shipping and everything else you had to figure out. And then of course, the diversification of a company makes a big difference. Like Amazon, like they're not really making as much money from shipping stuff and stuff you buy. They're making like government contracts on data storage and things like that. You watch Meta saying we have to diversify in order to maintain this. So some of these companies coming out and trying to already match that. Other ones are coming out and diversifying. If I go back in time to two companies I just mentioned, GE was a very diversified company. But Jack Welch said we have to be top three or I sell it. But they were top three in refrigerators and they were top three in like missiles. It's like they basically touched everything. Exxon, if you overlaid it on the S&P during their heyday, they looked the same as an S&P 500 fund because their stuff was so, like their actual product was in so many things. Again, oil was used, it still is, in so many things versus just cars and planes and boats. And so that is a cautionary tale a little bit on Anthropic and OpenAI. And what does that business look like? Like how profitable are they today and where do they have to get to do it? And if you're in one business line, so the upside is Anthropic actually could go from a trillion to 10 trillion, right? We don't even know what AI is going to look like from a valuation standpoint, but they can also have the opposite happen. Like they will soon be held to a different standard. And that's what we didn't talk about in the IPO. The one thing that Musk had that was very unique, and I don't know if the other guys are going to get away with, is you're going to buy my stuff and your share is going to have a diluted vote to it. Like I'm not even going to let you, I'm not giving you, like you buy a full share, you don't get a full vote. I've locked that up, right? I don't know that they'll get away with that. And when all of a sudden those private equity investors prices start to level out, because they level out a lot of times in public markets versus private markets, and you do have pension funds and you do have folks that are sitting there going, we actually want to vote our shares, you're held to a different standard on profitability. It's one reason why I think companies have stayed private longer is the ability to have the power to go, we want to go down this path and take this risk because we see the upside of it. No matter what institutional investors say, they don't think like that. If you're at the California pension fund, if you're at CalPERS, you're looking for an outcome versus kind of this outsized growth. So what do you think of the difference? Do you think that's going to be a difference in Anthropic and OpenAI versus Musk, where all of a sudden they have some people at the table, with shares that want to tighten things up a little bit and don't want it to be the wild, wild west?
Yeah, I think it's fair to say there was a large Elon premium built into the SpaceX price. And to his credit, he's already built Tesla, and investors have stuck around for a long, long time and been rewarded in that company. So as SpaceX came public, people looked at it and said, hey, there might be hundreds of billions of dollars of Elon premium because I've seen him do this once before. And I'm willing to give him that. I'm willing to cede some control over the governance, right? Because he's totally in control of it. He could sell a bunch of shares and still maintain control with his super voting shares. I don't think, to your point, Sam Altman and Dario at Anthropic have that same leeway. They haven't built public companies that investors benefited from. I don't think they've done a lot of good for their public perception. They've scared a lot of people about, doomsday scenarios with AI, taking all your jobs, all these things. So it's not, their public perception isn't great. I don't know that public investors will love handing over a lot of authority to them, giving them a big premium, and not being compensated for it. So that's certainly a risk that they have.
Yeah, I think the Musk premium, like you alluded to there, I mean, it's earned, right? I mean, it wasn't just Tesla. Yeah. He's done lots of things where he's actually been a decision maker that's moved in certain directions. Like there will be in my history suggests that there will be some people coming to the table saying to OpenAI and Anthropic, you need a professional CEO. And ironically, like there's a different pathway for this. Steve Ballmer, the owner of the LA Clippers, has all that Microsoft stock. He was there early and left, and Bill Gates hired him back because actually Bill Gates said, I'm going to be the chairman. I need somebody that, operates this place differently. But that can take out certain creativity if you don't get the right people. So that will be interesting to follow, I believe. Matt, any thoughts or, kind of just to temper or excite people about what you think we'll be doing with respect to IPOs? Are we, I think we like to use things like private equity because there's professional people overlooking that, and you have quietly a lot more exposure to that than you think. But what are the differences that you see, and what are your things that you would say to somebody like, hey, this is a good thing, and also I caution you on this?
Yeah, I would say if you like the idea of investing in an IPO, you're going to love the idea of investing in venture capital because you're just getting ahead. You're getting ahead of that. You're going to get some of those private market returns. You're getting access to, we see the headlines on SpaceX, Anthropic, and OpenAI. There are hundreds of companies in VC portfolios that could be that next thing. And so that's the play. If this kind of thing is interesting, the IPO is kind of the end point of that cycle. I'd rather get in way earlier. And we've begun doing that with some of our clients. Then, there is plenty of exposure to the AI trade just in US stock markets, plenty of technology exposure. Adding an overweight position to one of these, especially during the IPO, right? Like you can give it a couple months and let some of that volatility shake out. We don't necessarily need to chase a 20% day one return, right? Like that's great and all. It also can go negative 20, right? So we're taking a lot of risk that I don't know is necessarily warranted. So I would kind of reframe it as, what are we trying to accomplish here? Big picture, we want growth. We want access to the, high growth companies that aren't out there yet. Cool. That's where VC and private equity are acting today.
Yeah, I think that investors, and I think the way that we look at things is a little bit more skewed to what I said earlier and how an institutional investor looks at stuff. Because our clients are looking for an outcome and they'd love to have the big return, and I'd love to have the big return. And like you said, there are different ways to deliver that, and so if folks want to do it, it's like anything else. Like I think it can be a great investment. It's a great investment for part of your retirement or future wealth. Typically, people that historically have made money off of these things are, again, people that work there, and they work there real early and they see those things. So I'm excited. I'm excited about the different things that are out there, and we'll certainly keep an eye out for our clients. And like I said, we'll have different ways to expose them to this over long term. And what you just mentioned when you're talking about things like venture funds, like, I mean, I don't know that we have a lot of clients in it, but like Stepstone's venture fund, like some of the stuff has been great returns, and it's diversified by professional managers that understand like some of these things are going to be great, and some of these things that we think are going to be great, there's a reason why it's venture. There's a reason why, it was more speculative to invest in Anthropic 5 years ago than it is today. So the rules haven't changed on investments. All right, Matt, thanks. As usual, great spending time with you and with our clients. We always want people to give us feedback on things that you want to hear about. Reach out to us and tell us. Click and subscribe. Share our information if you think it was valuable with others. And we'll look forward to seeing you next time.